Thanks, Tom. This is Jeff Tjornehoj. I'm presenting the fixed income analysis for the quarter. I'm not going to rehash all the great economics that Tom put out there for the quarter that really affected everyone's mindset, but I do want to throw out a few other numbers that I found rather amazing. I didn't realize that, we heard about, let's say, Switzerland decoupling from the euro, the European Central Bank launching a huge program to stimulate the economy. But in the first quarter, there were a total of 26 central banks that around the world that cut policy. And I don't know if that's a record. That sure sounds like one to me. That sounds like a lot of central banks trying very quickly to stimulate local economies and try to get some more inflation out there. Because it seems like growth is really slacking off just about everywhere we look these days. So let's take a look and see what happened with bond funds. This is the Barclays U.S. Aggregate. This is kind of the mirror image of what happened with the stocks that Tom was talking about. Bond funds got off to a great start at the year, raced to a 2% gain on the Barclays Aggregate. And then things got softer in February and then rebounded slightly in March. And as we'll look through some of these slides, we'll see that as a recurring theme, with February kind of soft, March being a period where we're kind of reevaluating where we're going for the second quarter and the remainder of the year. So here's the big picture view of what happened with the various sectors that we're looking at. Treasury funds largely did well. Certainly it was better to be long duration than short. Similar story on the corporate side. The risk on trade was going to be more fruitful than those who had to sit back and take a cautious view. On the general domestic area, as far as corporate debt goes, everything was looking pretty good. World income, and we'll touch on the dollar strength again in my presentation. But as you can see, the dollar strength definitely hurt most of the funds in this area. And then on the municipal debt side, it was a very good quarter for munis. They didn't beat anybody until you consider the tax-adjusted returns, and things look a little bit better. So we'll start off by looking at the Treasury category here. So this is what the yield curve looked like over the last couple of periods. The red line is the end of the first quarter of this year compared to the end of the fourth quarter of last year and end of 2013. The curve is getting flatter. Things are starting to look a little shaky as far as the global economics picture goes. There's a lot of pressure to raise rates eventually, and I think there's a lot of concern that it's going to happen, it's going to happen, it's going to happen. We've been talking about this for quite a while, but the tough place to be right now is the very short end of the yield curve. It's getting relatively volatile there as investors are jockeying for estimates of when the Federal Reserve is going to raise short-term rates. So it's a tough place to be right now, and as we look at some of the performance, we'll see where the real money has been made at the medium and long end of the curve. But we can't talk about Treasury performance unless we talk about oil prices. Like Tom was talking about, it was a volatile period for oil. However, it did seem to find a floor, and this is just the WTI. This is not Brent. This is the U.S. domestic benchmark. Seemed to find a floor around $44. That's helpful for a lot of people because they view that as a threshold below which we don't want to go. It's certainly put more money in the pockets of consumers. We've seen those sectors doing relatively better over the last 6 to 9 months as oil prices have dropped by over 50%. But it's got people concerned that it portends a global slowdown and that it's probably not such a good thing to see oil prices decline farther and farther and farther. Now, will they decline farther? I have some reason to think that there could be a significant risk out there for them to decline precipitously. Maybe not next quarter, but perhaps sometime in the third quarter, maybe fourth quarter this year. We'll touch on that later. But as you can see here, pretty strong correlation between the two. The correlation was far tighter in the first quarter. I'm sorry, in the first month of the quarter, and then it kind of came decoupled in February and March, but the pattern is still there. So something to keep an eye on. As oil prices go, yields will tend to follow, I think. So over the course of the quarter, this is how the various tenors of the Treasury market performed. Again, yields everywhere were declining, except at the very bottom of this chart where, say, 3-month and 6-month yields were sort of treading water. If you're at that end, we're only talking about a 1 basis point swing in either direction to really change what was going on. For everybody else, similar story. You could almost retrace oil prices over this. As they went up, so did Treasury yields across the various tenors in February, and then March was a period of trying to gain back some of that rally. For the quarter, all of them were lower, except for the very lowest, anything under 6 months or under, which actually increased. So that kind of spelled the fate of the various Treasury funds out there. The longer the duration, the better they did. The next group to take a look at is our general domestic area, where we'll talk about corporate debt. And we'll start off by looking at some corporate debt total return indices. As you can see, high yield had a great quarter. They were up and away with a slight period of consolidation and profit taking in the second half of March before things started to go well for them again. Triple B and A rated were kind of jockeying for leadership throughout the quarter. I don't think investors had a strong opinion about where two very similarly rated companies would go, but overall we saw them put up some positive returns for the quarter. Now when we take a look at this on a spread basis on this graph, it tells a little different story. We saw spreads narrow considerably on high yield before they started to creep up near the end. Maybe people felt that the market rally had run away a bit too far. But elsewhere on Triple B and A, really wasn't a whole lot of change in the spread composition over the quarter. This is the Triple A at the bottom here. And as you can see, spreads actually widened a little bit on the Triple A side. So kind of an interesting pattern here. When we think about where spreads have gone over the quarter, and that the AAA is the one that's kind of pulling back, while overall high yield has been the one who's really been able to sustain a better rally. The next group to look at on the corporate side are loans. When we looked at them last quarter, we could see that whether it was the loan funds or the actual loan index, both have been very volatile, especially over the course of 2014. A lot of up and down movement as investors had various reasons to be concerned about the leveraged loan market. They changed their minds this quarter. Loans did, I think, very well. They still have some economic headwinds in my view, or I should say structural headwinds, because we still have a very low rate environment. Most of them are not quite ready to start resetting rates anytime soon. So there's not a lot of reasons for me to see excitement over loans, except to say that the market was probably oversold at the end of last year. So this quarter, we saw loan funds do pretty well. Like I said, they were loan funds themselves were up about 1.9%, which contrasts with, let's say, high yield funds, which were up about 2.16%. High yield definitely being in the driver's seat for this quarter. Next group to take a look at is world income funds, and we want to start off here talking about the dollar. And this goes through last year, but you can really see that since June of last year, it has just been on a tear. It got off to a huge start in January and accelerated in February. Tom threw out some of the numbers just to give you an example of where the dollar has gone. We saw it gain about 13% versus the euro for this quarter. So you can imagine where it's gone over the last year and a half. I'm sorry, really 15 months, we'll say. This quarter it was also up 5% versus the pound. It was relatively flat against the yen. The real story was in emerging markets, and we'll cover this in just a few slides. The Brazilian real was down 23% versus the U.S. dollar in the first quarter. Turkish lira down about 11%. Here's the comeback kid of the year so far, the Russian ruble, up about 4% against the dollar. Certainly with all the political problems that Russia has created in Eastern Europe, and the sanctions against them, and oil prices collapsing, Russia's faced a lot of headwinds. But I think traders felt that the ruble was a little oversold at the end of last year, and that maybe the things were starting to consolidate. Certainly, as oil found a floor, it was easier to make the case to get back into the ruble trade again. So here are emerging market hard currency and local currency funds, again with the U.S. dollar index. Now this is just daily over the course of the first quarter. For the total, the emerging market local currency debt group was down about 326 basis points. So they had a rough quarter. The hard currency figure was up about 81 basis points, which was not too bad considering the headwinds they faced with a strong dollar. So overall, again, we kind of figured that the start of the year was going to be a tough one for the local currency funds. They actually surprised to the upside, in my view, in January. They kind of outperformed, and then the bottom fell out, and that goes hand in hand with the strength of the U.S. dollar. And again, with Brazil really making it a difficult time for local currency funds to do well in this environment. I would expect more of the same in the second quarter. Brazil is really facing some tough political headwinds right now, with the Petrobras scandal seeming to cover a lot of politicians there, and stifling the governing powers until that gets resolved. So the next slide here is with the municipal debt story. Things have actually gotten a little strange for Puerto Rico. If we look at the bottom here, we've got the AAA general obligation funds. The darker lines are the most recent quarter end, end of first quarter 2015. The lighter lines are that same group at the end of the first quarter of 2014. So a year ago versus today. We look at the AAA throughout the rest of the United States, and yields have declined across the various tenors. Even a troublesome state like Illinois has found itself able to find some fans out there who have brought yields on its paper down over a variety of years. Puerto Rico, though, things have actually seemingly gotten a little worse year over year, where yields have started to widen out, up to about 2024. They remain wider through 2044, but Puerto Rico is in a world of hurt. However, that didn't stop high-yield municipal debt funds from putting up some very good numbers for the quarter, 1.55% for the quarter, and a lot of this includes Puerto Rico paper. So there's some good management going on out there if you can figure that one out. Over the year, high-yield municipal debt funds, over the last 12 months, they're up over 10%. So I guess it's all a matter of where you're buying your high-yield paper these days. Overall, single-state muni debt funds, I thought, had a pretty good quarter, on average up about 92 basis points. Certainly those at the shorter end of the maturity spectrum did less well. Short muni debt funds up about 18 basis points. So overall, not great at the short end. It was really the long end, people willing to take some duration and credit risk, who were strongly rewarded for that in the first quarter. We'll come to my outlook piece now and do a review. So at the end of 24, I thought the Treasury curve would wind up flatter at the end of the first quarter. That was true. I thought investment grade spreads would widen. I thought there would be more economic headwinds coming in the first quarter in the U.S. That didn't really happen. Investment grade spreads narrowed. I thought loan and high yield would have a tough quarter. They actually turned that ship around, which is kind of an interesting change of pace. I figured high yield would beat, not high yield, hard currency would beat local currency. That happened. Thought munis would outperform. That happened, especially on a tax-adjusted basis. For the quarter ahead, I continue to believe the Treasury curve will flatten. I'm now changing my view on investment grade spreads. I think they will narrow. I think the current pattern is going to hold. I think there's enough enthusiasm for corporate debt right now. We'll see the investment side also do pretty well on that on a spread basis. I think people have changed their view on high yield and loans, particularly high yield. Loans, I guess I could go either way on this, but it seems like they have some momentum right now, so I'm going to give them the benefit of the doubt. Again, hard currency will beat local currency in the coming quarter. I don't think that Brazil is going to get itself or out of the mess it's currently in. I think other emerging markets are also going to be in a similar position when it comes to commodity prices staying low, remaining low, and pressuring their treasuries. So we're going to see high yield beating local currency again. I think munis, probably not such a great quarter ahead. I think that we saw a fantastic amount of issuance in this quarter as people sensed in the fourth quarter of last year that rates would be going up shortly. So they held back on getting into the market. They saw that rates weren't going anywhere. They threw a lot of money out there, a lot of new paper. I think that it got some enthusiasm for it, but I think that enthusiasm is sated for now. And I don't think we're going to see quite as much of the bid in the muni market as we saw in the first quarter. So that's where I stand on the look ahead. So at this point, without any further questions, I will turn it over to Patrick Keon.